Hello traders, this is Forensic Forex with Deontay, where we analyze the details and specifics of the foreign exchange market. This video is going to speak on high probability scalp. We're mainly going to focus on the daily time frame, a 3-bar pattern, confirmation, entry, stop loss, and TP placement. With that being said, let's get into our disclaimer. Do your own research. My content is intended to be used for informational purposes only. Please do your research before making any investment or trade based on the information provided and consider your circumstances. You can talk to a professional or do your own independent due diligence on verifying any information that you find on my channel. This is a message for myself, Deontay, as I am not a professional. With that being said, let's get into our lesson. The Forex market has high rewarding trades to those who are patient. However, majority of retail traders are not disciplined enough to not trade every day. Retail traders who are disciplined are not worried about trading every day. Waiting for higher probabilities and higher rewards is always worth the wait. Before we get into the high probability scalp model, we're going to speak about swing highs and swing lows because they pertain to the model. A swing high is defined by a 3-bar pattern or a 3-day pattern, which essentially means there's a lower high on the left, a highest high in the middle, and then a lower high on the right. The same can be said vice versa for a swing low. A swing low is defined by a 3-bar or a 3-day pattern. There is a higher low on the left, the lowest low in the middle, and then a higher low on the right. Let's take a look at the chart to find some examples of a swing high and a swing low. Euro yen for the example, we're going to start in August. Going forward, we're going to find all our swing lows. So right here, I can see that this is a swing low. The lowest low is here. There's a higher low on the left and a higher low on the right. So this makes this a swing low. A swing low is only a 3-day or a 3-bar pattern. It only takes 3 days for this formation to form. It doesn't need 4 or 6 or 8 candles on the left and the right of that lowest low. It just needs to be 1 on the left and 1 on the right. That makes a swing low. So let's find some more. So we have one here. We have one here as well. We have another one here. We got quite a few of them. We have a swing low here. We got a swing low here. We got one here. 1, 2, 3. We got another one here. Look at that closely. 1, 2, 3. That's the swing low. You got one in here. 1, 2, 3. That's the swing low here as well. 1, 2, 3. This low is 142.510. This low is 142.566. And this low is 142.801. So this is the lowest low out of the 3 of those candles. So this makes this a swing low. So this is all our swing lows. Now let's look for our swing highs. Swing high is basically opposite to what a swing low is, and we're going to look for that now. So a swing high is going to have the highest high in the middle with a lower high on the left and a lower high on the right. This high right here comes in at 138.396 on its left side. The high comes in at 138.318, and the high down here, you can see it's obviously lower than this one, so this makes this a swing high. That's our first one here. Moving on, we can see on here, 1, 2, 3. That's a swing high formation. You can see here as well, 1, 2, 3. This is a swing high formation. That's that swing high right there. You can see you have another one, I believe, right inside here. 1, 2, 3. You got to see what high this is. This high is at 137.967, and the high next to it is 137.948. So this high is lower. It looks really equal, but this high is higher than that one. So that's our swing high here, because it's a lower high, highest high, and a lower high again. 1, 2, 3. Don't want to confuse anybody here. Another swing high we have here. That's the highest high, lower high on the left, lower high on the right. Going up here, the highest swing high we have here, we can see that one is really obvious. Look at that high, it's lower than this one. Look at this high, it's lower than that one. This is the swing high. Here we have another one, 1, 2, 3. And it looks like we have one that's really close to each other. It almost looks like a double top, but we'll see which one is the highest one. So this high comes in at 144.80 and this high comes in at 144.91. So this one right here is the swing high. So you do have to check the parameters of the candle because they do look relatively close and you could be considering it as a double top, but in all actuality it is a swing high here. So just be careful when you're looking at the wicks because some are much more obvious, as you can see, while others you may have to check to see if this high is actually higher than the other or if they're actually equal highs. But now with the little study, you'll be able to find what swing highs and swing lows are. Let's move forward. High probability scalp model. In a buy scenario, we must first locate the most recent swing high. Second, we are going to wait for that swing high to be broken. Once that swing high is broken, that indicates to us as a trader that momentum may be shifting bullish. Once it's broken, we're going to wait for a higher swing low for further confirmation. Once that swing low has formed, we're waiting for the third candle's high in that swing low to be broken. Once it's broken, we are going to go long, aiming for the daily candle's high, which broke the third candle's high in the swing low. The same can be said vice versa when bearish. Let's look at an example on UJ. We're going to be looking at UJ, and we're going to be starting at August, moving forward to present day. So we're going to look to see if a swing high or swing low is broken moving forward into this month. So we can play it out, speed it up a bit. So we have a swing low going into August, right here. And now we're waiting. And it looks like a swing high has been broken. 1, 2, 3. This is the swing high right here. So we can mark this off. So now at this point, we're in high alert. Now we're paying attention. We're like, okay, momentum potentially is shifting bullish because we broke a swing high. 1, 2, 3. What we need to happen now is a higher swing low to form. This same formation that you see here just needs to be formed again, but much higher. Let's see if we get that. So we technically do 1, 2, 3, because this is broken here. It is included in this break, but you can see that the swing low does form. This swing low, 1, 2, 3, is higher than this one. So we can consider this the swing low. The third candle in that swing low, its high needs to be broken for us to be fully convicted to get the high probability scalp. So we want to see this high broken, not the low. We want to see the high broken of the third candle in the higher swing low after a swing high has been broken. We want to see the third candle's high to be broken. Let's see if we get that play out. Next day, indecisive. And then the next day, price drops. So it breaks the third candle's low. So this model so far wouldn't have followed through to get you a trade set up. So you're still following momentum. Price instead now breaks a swing low. 1, 2, 3. So the momentum is potentially going what? Switching to go bearish. Now I need to put this down here. So we're paying attention for potentially some bearish price action and commercials to increase their net shorts. Let's play it forward. So now we're waiting for a swing high to form, a lower swing high. So we have a swing high here, 1, 2, 3. That's a swing high, but we're looking for a lower swing high to form. So we potentially have one here, 1, 2, 3. That's our swing high. So we'll mark it off. The third candle's high does not need to be broken. We want to see the low broken in the third candle because we're shifting bearish. The momentum or the idea of the swing low being broken on the daily time frame is showing us that momentum is potentially shifting bearish. We press play and we mark the low so we can see that. We want to see that low broken. Press play. Instead, the high is broken, right, of that third candle in that swing high. 1, 2, 3. The next day, instead of taking out the low, it took out the high. While doing that, it also did what? It took out that swing low. So we'll take this one off. And we'll keep that. This swing high being broken makes us change our bias to what? Being bullish. So we're on high alert again, once again. 1, 2, 3. It's broken here. We're waiting for a higher swing low to form. We do have it. It's even marked off already. 1, 2, 3. Right? Swing high broken. Do we have a swing low that's higher than the previous swing low? Absolutely. We have one here. 1, 2, 3. This one's higher. And this one is the lowest one. This is higher than this one. This is higher than this one and this one. So we have a ascending, it looks, trend unfolding, right? They're building in or accumulating and waiting to take it off and blast it off with a spring or like up, because it's just accumulating back and forth. It's ranging. But eventually you're going to find the trend that the commercials are leaning towards. If you follow the steps properly, you're most likely going to get yourself a high probability scalp. And a little bonus, you may be able to find a trending market. So swing high is broken. What are we waiting for next? A swing low, a higher swing low to form. We got it. 1, 2, 3. This third candle's high is what we're paying attention to. We're waiting for this high to be broken to give us more conviction to be bullish. We press play. The third candle's high is broken by this candle. This candle right here. This daily candle breaks that third candle's high. So now we have a better understanding. Okay, momentum is most likely going to be bullish. We're going to be going into an uptrend. We are going to see commercials increase their net longs. So this high here is now going to be the target high. The third candle high is broken by this high. So this candle's high is going to be what we're going to be targeting as the high probability scalp, the high here. So we're looking for a high probability raid on the buy stops above this high here. And we're going to play it forward. And we're going to see the result the next day. Price goes up. So that was a high probability run on the buy stops. We know most likely that price is going to run through this high. Now, you may be asking yourself, Deontay, how could I encapsulate or formulate some type of trade here? Well, there may be a few ways. What I can tell you is you wait till midnight and you buy below midnight opening price. So you're buying in a discount and you're holding all the way up to London close. Or you trade below the Asian session. So if price comes below the Asian session intraday, buying below the Asian session is a high probability because the sell stops are taken out and it could be a fake move to the downside, but then the commercials actually run it back up, take out the Asian session high and run higher. Now that might sound a little advanced for some traders, but trying to envision yourself, okay, the next day I need to be bullish because this candle here took out this candle's high, the third candle's high in that swing low, the higher swing low. After the swing high has been broken, we wait for the swing low. That third candle's high, we're waiting for it to be broken here. This candle's the target. This is the high probability scalp that we're waiting for. Think about that. What is going to occur? If it's going to be a bullish day, there needs to be some type of potential fake out on sell side liquidity, mitigating the people that think that, okay, price is going to dump or drop to the downside, and then they fade it and they run price the opposite way. That's what needs to be going on in your mind during the high probability scalp. Now, with that in mind, you can hold for further days. So let's say, okay, you got the high probability scalp and it was successful. You got the bullish run here. However, the next day, what are your odds of being bullish? Probably more than 50-50. Odds are it may be more like 80-20 that the next day may be bullish, right? Because now we know that the momentum has shifted all purely off of price action. We notice that the momentum has shifted to the upside following the steps. Now this high can also be a run on liquidity, running this old high. Not saying it can't run the low, but odds are it's going to run the high. Let's follow along. Let's see what happens. Price opens literally above the high or exactly at the high and runs even higher. What are the odds that the next day might be bullish as well? Let's see. Another one. Let's see this high as well. See where this goes. And this one actually comes down. However, the main idea of getting that high probability scalp started from this swing high being broken first, then that swing low, a higher swing low forming here. 1, 2, 3, third candle is broken. And I know I sound like a broken record saying it over and over again, but it's the only way that you're going to understand and encapsulate what I'm trying to say to you. 1, 2, 3, right, is forming after this is broken. A swing high. So you're waiting for a counter move down. After that swing high is broken, you're waiting for a potential, okay, retail traders think, okay, swing high is broken, it's probably going to fade. No, we're waiting. Got to be patient. Got to be disciplined. So you can see how it takes us even further. So you can potentially grab more pips. Now, for most people that know, US dollar is strong currently, especially against the yen. This is probably the mega trade of the year. But you'll see that if you were to hold from that high probability scalp to now, you will be sitting on some great profit. So as you can see, price runs pretty far. So that's just one example with UJ. We're going to take a look at a few other pairs and some examples where it doesn't work out. Example, you can see that we're looking at GU versus US dollar, and I made this post on TradingView August 1st, 2022. So if you want to check it out, I'll leave a link to the TradingView post in the bio. You can see the swing low here starts the story, and then moving forward, you can see how I'm able to anticipate previous daily highs being broken or a high probability run on a high. There are some PD arrays in this video, however, I am not going to be covering them. I'm just going to speak simply on high probability scalps. So it starts here, that swing low going into July. We can see it's broken. This puts us into alert that potentially momentum is shifting what? Bearish. There's going to be a bearish tone that's going to unfold. However, we want to see a lower swing high form. So once this is broken, we're going to look to see where we have our most recent swing high, which is here. And we want to see a lower swing high form. So the same formation we want to see form, but lower than this one here, after a swing low has been broken. So we wait. One, two, three. So we finally get that lower swing high. So we have a possibility of price persuading us that it's going to be bearish because we have a lower swing high. This third candle now is what we're going to be stalking. It's low. Because we're bearish, we want to see its low broken, not the high. Now, with this model, you do have to be patient. You're not trading every single day, but however, you're trying to put high probability odds on your side to favor your trade for that day. We're waiting for that third candle's low to be broken because we are on a bearish tone. We are expecting or anticipating a lower swing high, and we're going to sell going into it. So we have that swing high, boom, and now going into the swing high. So once we 1, 2, 3, we're looking to sell after this third candle's low is broken. So it's broken here by this candle. So this candle here should be the high probability scalp to the downside. So tomorrow, we're trying to find an area to sell. We are more persuaded that price is going to take out the low and not the highs, and definitely not the swing highs. And it's going to keep breaking swing lows. We'll play it forward. And you can see here, this could have potentially been a failed trade for you because they didn't take the low out, it took the high out instead. Depending on your stop loss, may it be a longer term or position trade, you may have a larger stop above a swing high. May it be this one here, or the last 40-day swing high you're probably looking at as your stop loss. However, if you're doing this as an intraday trade, you may have been stopped out because most people have their stop loss either above or below the previous daily high or below the previous daily low. So this would have been a losing trade here following the steps. Moving forward though, you'll see we do break another swing low, 1, 2, 3. So we'll take this off so we can still follow the message of what's going on. 1, 2, 3. Another swing low is broken. We're waiting for a swing high. Do we have a swing high? We do. 1, 2, 3. That's a swing high. This third candle here, we're waiting for it to be broken. and we don't get that. You can see prices in between, but we're still waiting. Instead, it breaks the high. So it was indecisive. So it was an inside day candle. So it's inside this candle's range, high and low. Price then decided to go up, taking out what? A swing high. So now momentum is doing what? Potentially shifting back bullish. So we're in alert again. We're waiting for a swing low to form, higher than the most previous swing low. So we have a swing low here, 1, 2, 3. We want a swing low to form higher than this one now. And we're just going to wait. But now here, we have a higher swing low, 1, 2, 3. This third candle's high is what we want to see being broken. And you can see it's broken there. Bring it back. Price is broken here by this candle here. So that means we know that this candle's high is going to be the high probability scalp. We're going to be looking to buy whenever the next daily candle opens or forms. We want to be a buyer tomorrow. This is the high probability scalp because it took out this third candle's high. Now we're aiming for this as the target. This is your target. Press play, and we're most likely going to run the high. Boom. That's a high probability scalp there. We know that it's most likely going to run the buy stops above this high. It could shoot much more than this, but you can see here, it just took it out real quickly. And then moving forward, you can see now, previous daily highs just keep being broken. Normally, once you have momentum on your side, you're going to normally find yourself in a trending model. That's just a little bonus. Look at how previous daily highs keep getting broken. It's not by coincidence that this happens. This is just the structure and code of the market. And you can see here that was an outside day, takes both sides, but eventually still keeps pushing up bullish. But until we hit a swing low or break a swing low, you'll notice that the market will start to shift again. Look at this swing low being broken here. 1, 2, 3. There's a shift here. 1, 2, 3. Look at this swing high. 1, 2, 3. It's the same thing. 1, 2, 3. Look at this swing low being broken right here. 1, 2, 3. Swing low broken by this candle here. Will we see a swing high form for us to go short again? We have 1, 2, 3. This third candle's low needs to be run for us to want to be bearish. And we have that lower swing high that we're trading in. We press play, waiting for that third candle's. Nope, instead, the high is broken. So it resets itself, and then we have a swing high broken. And it continues and continues and continues. So once you follow the steps, you're not going to be impatient. You're going to be very disciplined to get into the market. So you're not executing a trade every single day. You're probably executing a trade every couple days, maybe every 5 days. You're going to get into a trade. But then once you get into that trade, the odds are going to favor you much more. You're going to be able to hold a trade potentially for the next 10, 20 days, especially if it's going to be trending. When it comes to this model, some entry techniques that you can keep in mind when bullish is buying at or below midnight opening price. Buying below midnight opening price when bullish is a higher probability for you as a trader because you're buying in a discount. It is much smarter and wiser for you as a trader to buy at a lower price. Buying below midnight opening price is a good key point. Buying below the Asian session low is also another good key point because we know below the Asian session low, there's going to be sell side liquidity and sell stops. Retail traders are most likely going to look for a breakout trade to the downside when the commercials are normally going to fade it and cause a reversal, trapping retail traders short. You can also buy after a 15-minute swing low is broken in the New York Open. And vice versa, when bearish, you can sell at or below midnight opening price. So basically what you're doing is you're selling in a premium. You're selling your stock or you're selling the value of an asset at a higher price. You can also then sell above the Asian session high. Selling above the Asian session high is going to have buy stops and buy side liquidity, trapping breakout retail traders to the upside while commercials fade and give them a reversal. You can also sell after a 15-minute swing high is broken in the New York session open. Some stop loss ideas. So when bullish, you can place a stop loss below the previous daily low, or you can place a stop loss below the most recent swing low on the daily time frame. Even further yet, you can place a stop loss below the 20 or 40-day IPTA look-back data range low. Stop loss techniques when bearish, you can place a stop loss above the previous daily high, or you can place a stop loss above the most recent swing high on the daily time frame. And further than that, you can place a stop loss above the 20 or 40-day IPTA look-back data range high. Now, when it comes to the IPTA look-back data range high or low, this is more of position trades and swing trades, trades that you're going to be holding for more than 100, 200, 300 pips. You're looking to hold these trades probably for 10, 20 days. And since you're placing a stop that's below the 20 or 40-day low, it's most likely going to be a hefty stop loss. So anywhere from 100, maybe even 200 or even 300 pips, you're going to want to bank on twice the risk or even triple the risk. This brings me to the main concept of the lesson. A bullish bias simply equals a swing high broken followed by a higher swing low. A bearish bias equals a swing low broken followed by a lower swing high. The commercials are turning the market around in 3 bars or 3 days. All asset classes make turning points in swing highs and swing lows. This concludes our lesson today. Hopefully you learned something new today. As always, I'm going to leave you off with a quote. Take advantage of every opportunity. Where there is none, make it for yourself. Marcus Garvey. Peace.